Hello, everyone. Thank you for joining the launch of our latest report, Critical Moves, Crowding in Capital to Finance Mineral Supply Chains. Over the past few years, we watched a growing number of international critical minerals partnerships take shape, including the Critical Minerals Resiliency and Production Alliance and FORGE, the successor of the Mineral Security Partnership, alongside many bilateral MOUs. These initiatives have different names and different memberships, but each depend on the same set of actors to actually get the projects over the finish line: export credit agencies, development finance institutions, and government-backed funds. This report provides the first comprehensive comparative analysis of export credit agencies, development finance institutions, and government-backed funds across the G7, Australia, South Korea, and looks at what it will take for allied governments to build secure and sustainable critical mineral supply chains. This report has been a long time in the making. Personally, I was first exposed to these institutions working with Charles Barnett at XM on what I believe was the first CTEP LOI for a minerals project. Since then, SAFE has spent years building relationships with US public finance institutions and their international counterparts, including through our work on Minvest and the MSP Finance Network, which has now been folded into FORGE. It also builds directly on our earlier work, the report that we launched in 2025, Resources for Resources, Financing Critical Minerals Supply Chains. One of the key findings from Resources for Resources was that the private sector on its own is not able to take on the unique technical, financial, compliance, and geopolitical risks that critical minerals projects entail. China has exploited that gap for 2 decades now, channeling roughly $98 billion into overseas minerals projects since 2001, all while maintaining a tight grip on processing and refining. The West has not matched the scale or coordination despite the recent surge of attention to the sector. The IEA's Critical Minerals Outlook that came out a few days ago found that public finance commitments in advanced economies have reached an impressive $65 billion in 2025, a substantial increase over prior years. But the gap remains between commitment and deployment. How do we close it to meet the strategic moment? This report addresses that question directly by examining what drives the gap between commitment and deployment by assessing institutional mandates, financing instruments, geographic restrictions, and risk tolerances. As we prepared this report, we conducted interviews with institutions that we profiled and gave each of them an opportunity to review our findings before publication so that our analysis is both accurate and genuinely useful to the institutions, governments, and private sectors players. Hopefully, all of that will translate into tangible results on the ground. To help ground today's discussion in the international critical minerals landscape, it's my pleasure to introduce our introductory remarks done by SAFE's partner in the Minvest Initiative, Acting Deputy Assistant Secretary of State for Energy and Critical Minerals, Reggie Singh. Reggie, over to you.
Thanks, Abigail, for the introduction. It's a pleasure to be here today to help kick off this exciting webinar. So I know you're going to spend the next 2 hours going over a number of topics. It's just a pleasure for me to spend a few minutes to help talk about SAFE, how it's been an excellent partner, and what we can look forward to in the months ahead. So SAFE has been an excellent partner to the US Department of State and the US government more broadly in supporting the development of secure and sustainable supply chains for the United States and our like-minded partners. Earlier this year, Secretary Rubio hosted a critical minerals ministerial with 55 countries. Among the key initiatives launched that day was FORGE, the successor to the Mineral Security Partnership, or MSP. As Abigail referenced in her remarks, SAFE's early work on the MSP through the Minvest partnership was instrumental in bringing public finance institutions and the investor community to the table and building interest in collaborating through this forum. We look forward to continuing our collaboration with SAFE through Minvest as we advance FORGE, as well as PAC Silica and other US-led international critical minerals initiatives. SAFE's thought leadership on the challenges and opportunities in the critical mineral sector is unmatched in its rigor. The United States assumed the FORGE chairmanship this month, building on a successful term by the Republic of Korea. We intend to leverage this role to translate Forge's guiding principles into coordinated policy and project-level action among our partners. The United States has been mobilizing significant capital towards strategic projects through both our public funding institutions and the private sector. We want to ensure this mobilization happens in close coordination with our partners so that we are all stronger and more secure. SAFE's report, Critical Moves, Crowding in Capital to Finance Mineral Supply Chains, will prove to be an invaluable resource in this endeavor. And I'll take the liberty of quoting a bit because it's so integral to our work. As the report emphasizes, the quote, high stakes geopolitical resource race will not be won through communiques or new institutions alone. It will be won by the countries that can mobilize capital at the speed and scale required to move strategically important projects into production and connect them to resilient manufacturing supply chains, end quote. The Critical Moves report doesn't just describe the current state of play, it also tells us what we need to hear to move forward. For example, it finds that many of our institutions remain too risk averse or lack the capabilities this moment demands. That sort of candor is exactly what makes it useful. We cannot correct what we do not first acknowledge, and these findings give us a clear-eyed basis for the actions that will actually move us toward our goals. We understand that we are all navigating a complex system domestically and internationally while facing a common competitor that has a considerable head start. It is only by working together that we can reach the supply chains, we can reach the secure supply chains our national and economic security depend on. So with that, I want to thank SAFE for organizing today's webinar, and I look forward to the discussion ahead. Thank you.
Thank you so much, Acting Deputy Assistant Secretary Singh. Appreciate you also flagging that tidbit from the report that will hopefully encourage people to read the hefty document for those insights. We have a robust presentation for you all today. We will begin with remarks from Ayelet Zamek, our lead researcher on this report, and our Minvest delegation coordinator. She'll cover the report's key findings and recommendations for those of you who haven't had a chance to read it yet. Following the presentation, we will hear from 3 panels featuring U.S. public institutions, partner country institutions, and then private sector players, each offering a unique perspective on the critical minerals financing gap and how all of their organizations can help fill it. The time is right to examine all of these different roles and both find ways to coordinate with the private sector and catalyze more investment. So with that, I'll turn it over to Ayelet to dive into the report.
Thanks, Abigail, and welcome everyone. It's my pleasure to present Critical Moves, Crowding in Capital to Finance Mineral Supply Chains. If we can please bring up the slides. I hope this presentation will give a taste of the analysis you can find in the report and our recommendations. The full version is available, of course, on our website. To provide a roadmap, Critical Moves seeks to do 3 things. First, to provide an overview of the role of public finance in the critical mineral sector, including the types of institutions actively supporting projects and the tools they have in their arsenal. Second, to comparatively assess public finance institutions, mapping their mandates, geographies, financing instruments and authorities, and risk appetites so policymakers and practitioners can identify where alignment is possible and where gaps remain. And third, to share cases and lessons learned of international cooperation through co-financing of critical minerals projects and to provide high-level recommendations to promote future collaboration across these institutions. Like any good policy researcher, I will give you the bottom line up front. No single institution possesses sufficient resources to finance the full pipeline of exploration, development, and processing projects necessary to build resilient ex-China supply chains for all critical minerals. International cooperation is necessary and possible. The scope of this report covers public finance institutions with the ability to support overseas projects from across the G7, as well as the European Union, Australia, and South Korea. These countries share a broad consensus on promoting secure and sustainable critical minerals supply chains. This report also focuses on national institutions because they respond directly to national policies and strategic priorities. The first point of comparison we make is on mandate. Mandates are a foundational point of comparison because they dictate institutions' authorities and activities with direct implications for the types of projects institutions may support, including sectors, geographies, and risk levels. In the report, we identified three broad categories of mandates: development, export-import promotion, and strategic priorities like defense and national security, resource security, and supply chain diversification. Although mandate is closely related to institution type, there are nuances, and many institutions have mixed mandates, as you can see. Challenges can emerge when public finance institutions' mandates limit their abilities to support government policy priorities, or they lack the authorities to fully fulfill their mandates. Disconnects between institutional mandates and broader national economic or security priorities can result in viable projects failing to access public financing. We are seeing examples of institutions evolving their mandates to advance critical minerals priorities with more effective tools. UCAF, for example, UK Export Finance, is working through the legislative process to expand its mandate to take on a wider trade and investment remit, and we'll be able to hear more on this process directly from UCAF on a subsequent panel. Overall, public finance institutions across the G7, Australia, and South Korea share a common suite of financing instruments and tools with which to support critical minerals projects. While we make some observations about the trends related to the prevalence of political risk insurance and the growing importance of equity, the real distinctions among these institutions lie more in their capacity and willingness to deploy these instruments, including financing volumes and risk appetite, rather than the instruments themselves. These structural and operational factors ultimately determine institutional effectiveness in critical minerals financing. Financing capacity itself varies by country and institution. The proliferation of critical minerals and supply chain related programs, such as Exim's China and Transformational Exports Program and UCAF's direct lending facility and critical minerals supply finance, reflect the heightened strategic prioritization and corresponding resources. However, even pulled together, this does not compete with Chinese state-backed financing. Today, 74% of Beijing's minerals investments flow through state-owned commercial banks. G7 European, Australian, and Korean institutions have one major advantage, though: access to private capital markets. Consequently, much of this financing is designed to mobilize co-investment, leveraging public institutions' risk mitigation effects to attract private sector partners. However, the success of this crowding-in model only works if private investors trust that public commitments will hold, meaning that institutions must be prepared to sustain commitment to a stable policy environment, transparency, and reliable access to finance over time. The opportunity moving forward is better coordination and co-financing among institutions to crowd in this private investment and close strategic financing gaps. The calls for public finance institutions to step up their support for critical minerals projects is largely driven by the fact that critical minerals projects entail risks that other sectors do not face. Therefore, an institution's risk appetite is a large determining factor in whether it can support a project or not. The risk appetite assessment methodology derives from the 4 categories of risk SAFE identified in its previous report, Resources for Resources, as part of a year-long collaboration with a group of leading critical minerals investors. These categories of risk are technical risk, financial risk, compliance risk, and geopolitical or political risk. For this report, we developed a set of key questions indicating appetite within each risk category. They've shared the list of questions with all the institutions profiled to provide them with the opportunity to answer them before completing the analysis and publishing the report. They've scored the responses for each institution and then classified the composite scores for each risk category into low, moderate, or high risk appetite, which you can see here. The report includes the full methodology if interested. Our risk appetite assessment surfaced three main findings. First, few public finance institutions are willing to take on the technical risks of exploration activities, early stage projects, and emerging technologies, which contributes to the dearth of financing of all kinds to these necessary activities. This financing gap may have a detrimental impact on the long-term supply chain security and competitiveness because of its role in developing project pipelines. Second, while most of the institutions profiled share moderate financial risk appetites, they operate under different financial risk management constraints on how they deploy capital. These can be statutory default rate caps in the case of Akram, or additionality requirements in the case of several other institutions. Finally, according to this assessment, most of the profiled institutions have moderate or high political risk appetite. However, this finding does not align with private sector perceptions of these institutions' willingness to support projects in risky jurisdictions. The biggest takeaway is that most institutions cannot tolerate multiple forms of risk simultaneously. And overall, there is a mismatch between the level of strategic urgency governments express and the level of risk institutions are actually structured to absorb. Which brings us to international coordination. There are a multitude of benefits to international cooperation, including raising the overall financing levels potentially available to critical minerals projects, enabling institutions to deploy their respective instruments and risk appetites strategically, reducing perceptions of project risk, deploying resources efficiently, and pooling demand. However, international cooperation does face operational and political barriers. On the operational level, separate due diligence processes create redundancy and extend timelines. Challenges with project-level information sharing limits institutions' ability to coordinate strategically across deals. On a geopolitical level, the most fundamental challenge is lack of unified, coordinated investment strategy. The Mineral Security Partnership initially provided some direction through a curated strategic project list, and we are keen to see what happens with this list or similar initiatives with the launch of Forge. Perceptions of competition, that countries are capturing critical minerals resources at the expense of traditional partners, also creates underlying tensions and hesitations about deeper coordination. While cooperation can come in different forms, in many discussions, co-financing appears to be the ultimate goal. The report includes 4 case studies of successful co-financing with multiple public finance institutions. In each case, no single institution could have advanced the project working alone. To achieve this, the report provides recommendations to promote future collaboration across public finance institutions internationally. The report's recommendations to strengthen public finance deployment focus on 3 areas of improvement: enabling international coordination, improving whole-of-government approaches, and involving institutions' mandates, conditions, and risk tolerances. It's important to note that domestic institutions and other policy interventions are also necessary. First, to strengthen this cooperation, participating governments should establish secure platforms for sharing project-level intelligence that safeguard commercial and national security interests. They should also work to harmonize due diligence and complying processes when possible. Public finance institutions should be empowered as active participants in international critical minerals partnerships to support implementation and facilitate co-financing, project pipeline development, and deal-making. Governments should also better coordinate financing across their respective domestic and international agencies for projects spanning the value chain. This will also include expanding public finance institutions' local presence and diplomatic engagement in resource-rich jurisdictions, an area where we also lag China's denser commercial and diplomatic footprint. Finally, on evolving institutions' mandates, conditions, and risk tolerances, governments should take steps to align institutional mandates and authorities with critical mineral security objectives. Key areas of intervention include offtake requirements and domestic linkages, technical and financial risk tolerances, and access to private sector expertise. We have clearly woken up to the problem and identified these institutions as key pieces of solving it. In writing this report, we aim to create a resource that can genuinely help policymakers, governments, investors, and industry leaders make better decisions to achieve our shared goals. By bringing together the most relevant information on these institutions and evaluating their respective strengths, limitations, and opportunities for collaboration, We hope we're playing our part in advancing our shared goal of secure, sustainable supply chains in the face of a common competitor. Thank you all. And with that, I'll turn back to Abigail to kick off the first of our 3 panels with representatives from these excellent institutions.
Thank you so much, Ayelet, for the presentation and all of your very hard work on this report. I'm now pleased to shift to the show you, not tell you part of our webinar, where we're going to have our first panel featuring U.S. government leaders who are delivering on U.S. critical minerals commitments through creative financing, loans, equity, political risk insurance, and more. We have with us Sarah Whitten, Senior Vice President and Chief Commercial Officer at Ex-Im Bank, Tom Hazlitt, Managing Director of Policy for Energy, Critical Minerals, Africa, and the Middle East Policy at the U.S. International Development Corporation, and then lastly, Asad Akram, Managing Director and Global Co-Head for Critical Minerals, Materials, and Metals at the Office of Strategic Capital within the Department of War. Thank you all for joining us. Sarah, let's start with you. This report focuses on public finance institutions in the US and then its partners across the G7, as well as the European Union, Australia, and South Korea. Ex-Im recently convened the G7 ECAs earlier this year, so it would be great to hear from you what coordination predating that, following that has produced so far, and where you see it heading, particularly in the critical mineral space.
Thanks, Abigail, and thanks to you and SAFE for hosting us and including Ex-Im in the U.S. government panel this morning. As you mentioned, I'm as the Chief Commercial Officer at Ex-Im. I've got the pleasure of leading both our origination and our policy teams within Ex-Im. And thank you for both you and the recognition that your report had around engagements that we have had for many years under our CTEP program. And of course, Charles Barnett has been a key driver in all of that. Under the policy side of my shop, we have very formalized engagements with ECAs across the board, particularly as it relates to the OECD. And within our organization, there's a deep recognition of the importance of critical minerals, both from a U.S. economic security perspective, as well as from an industrial competitiveness and national security perspective as well. As you mentioned, Abigail, we hosted the G7 export credit agencies at the end of April this year. We take turns hosting, so this was our turn to host all of our peers here in DC. And what was remarkable is, of course, we're different agencies under different governments with slightly different mandates. But so the theme, I suppose, in all of the conversations was that we don't necessarily agree on everything. But some of the things that we agree most on were all pertaining to the fact that we need to move quickly, efficiently, and more in a coordinated fashion as it relates to critical minerals, or certain of our peers call them critical raw materials as well. And so this sector really centered much of the conversations that we were holding amongst our G7 peers at the end of April. And we all agreed that we need to work together to better secure our respective supply chains. And that, I think, is the new, and it's not new, of course, but it's a more emphasized realization that no single financing institution can tackle this problem alone, which, of course, is demonstrated in your report. And this is why we've continued to prioritize deeper coordination with the G7 counterparts, as well as through the OECD framework. One early win as it relates to partnering with other export credit agencies, which predates a lot of these conversations, is the single point of entry, which we had put in place several years ago, in fact, with Export Finance Australia. And I see that Dan Smart is on one of your later panels as well. We're so pleased because we've had such a great partnership with EFA from before Dan's move to Washington. So really thrilled to continue to work with him. And through that, we've had partnership on specific deals as it relates to transactions in Australia, as well as transactions in the United States together with EFA. And I think that demonstrated the ability for us to be able to partner with our peer export finance agencies on specific transactions and created a roadmap for what could be achieved with some of the other G7 ECAs as well. Further, following our engagements at the end of April, Exim has really increased our prioritization of critical minerals and what needs to be done in order for us and our peer agencies to be more competitive. And so through the initial conversations, we returned back to the OECD for a ministerial in early June. And through those engagements, we discussed that some of the much needed reforms within the OECD financing frameworks need to link back to strategic industries and in particular, again, critical minerals. And so these negotiations are ongoing. As you can imagine, with so many different governments involved through the OECD, these negotiations do tend to be protracted, but I do see that there is a very clear recognition that this needs to be resolved urgently and at pace. And so we continue to keep that energy and keep that pace up in order to achieve tangible changes to the financing frameworks within the OECD. And Exim has, in particular, through our partnership with US Treasury as well, been pushing for those reforms. One last thing I would just add to this point is, and we've shared this with Abigail and with SAFE as well, Exim, we've got an annual report that we also issue called the Competitiveness Report. And so we just issued that just a couple of weeks ago. And again, very, very pleased to see that some of the themes that were coming out through our internal analysis was also echoed in the SAFE report as well. And so I think the SAFE report does a fantastic job in capturing the competitive environment, not just amongst the US government agencies, but also the international agencies. Of course, our analysis is specific to export credit agencies, but many of those themes were elevated in SAFE's analysis as well. So I'll pause there, but thanks.
Thanks so much, Sarah. I loved your line that you gave a couple of times in terms of working quickly, efficiently, in a more coordinated fashion, despite acknowledging that even the names that we call these critical minerals, transition minerals, raw materials can be a little bit different. And also appreciate the one-stop shop, which we feature heavily in the report. And great to see coordination in action with Dan getting a call out, and we'll hear more from him on a later panel. Tom, I want to turn to you. You've also been working alongside all of your DFC colleagues with fellow development finance institutions on critical minerals, including some collaboration on financing related to the Ukraine and US-Ukraine Reconstruction Investment Fund. I'd be curious if you could speak to that collaboration in practice. Feel free to give different examples. But what does it suggest in terms of the potential for deeper DFI coordination on critical minerals more broadly?
Thanks, Abigail, and I really do appreciate you having us on for this and the report, which I think, again, does a great job of laying out some of the challenges, but also some of the things that have been going well recently. So again, appreciate the opportunity to talk about our work. So I think DFC recognizes the importance of working with other DFIs to create opportunities to share risk and take on more impactful opportunities in ways that reflect the different strengths of each institution. Our work in Ukraine, including through EURIF, the reconstruction fund that you mentioned, is a good example of this. Throughout the startup of that fund, and then as we go through pipeline opportunities, we're working closely and sharing pipeline in a deliberate manner with other DFIs, in particular EBRD, which of course has significant interest in that market as well as significant experience. And so we're actively trying to find ways to bring other partners in, because it is such a challenging place to work, even as there are significant opportunities in many sectors, including in mining. You can also see this in the partnership agreement we signed recently with Multilateral Investment Guarantee Agency, or MIGA, which was signed at the Ukraine Recovery Conference in Poland earlier this year. It's going to leverage MIGA's insurance capabilities to catalyze and support opportunities for private sector investment in Ukraine in connection with the EURIF pipeline. And so there, again, we're trying to really draw on the specific capability of MIGA to work alongside us as we deploy capital in the form of equity or debt, and again, providing that insurance that also helps other investors get involved. We're working closely with other DFIs in several different markets on potential critical minerals projects. There has been an uptick in interest, I think, in this space, and we recognize that, similar to how we worked in a number of other sectors alongside DFIs in the past, that there's a lot of opportunity for collaboration to improve how we do our work. I think in ways that are similar to what Sarah referenced, there's still ongoing discussions around questions of offtake or risk tolerance and that sort of thing. And we're having those discussions, you know, in live, as it were. But hopefully, as we get on the same page increasingly and do a few of these projects, it'll make future opportunities much more efficient and streamlined. And so, again, sometimes I think things maybe move slower than we would like the first time around, but then we have a shared set of approaches that we can deploy going forward in the future. And I think we're really looking forward to having that help scale and, again, get a more sustainable pipeline going for future opportunities.
Thanks so much, Tom, and great to hear about the coordination with the European Bank for Reconstruction and Development and MIGA, as you mentioned. I think one of the findings of the report is that it's always helpful to lean on institutions that have more of an on-the-ground capabilities to complement the deployment of U.S. taxpayer dollars so that we can be as efficient and effective with the utilization of those funds as possible in supporting these very needed projects. Excited to hear kind of where we go on some of the offtake and risk tolerance discussions you said you're having, and I think we'll have more questions on that a little bit later in this discussion. Asad, OSC is the newest institution on this panel, yet you've already closed several high-profile projects, deals. What gap in the existing finance landscape is OSC specifically designed to fill, and how do you complement the other authorities the Department of War has, like the Defense Production Act, Title III, and IBAS?
Yeah, great question. Thanks, Abigail, for having us again as the youngest agency in this domain. And really appreciate the work you guys are doing. From the OSC's sort of inception and creation, OSC was created to invest in the component layer for things that power national security. That's across the board, across a bunch of different categories. Our biggest category is critical minerals, but we sort of are there to address this gap where the component layer for our national security is not directly addressed at times by a single agency. So we have a singular mandate, which is to attract and scale private capital for national security. We don't have other competing mandates or requirements that get sort of conflated with that. That's a single thing we were created to address, is how do we ensure that the components and the building blocks, whether it's the minerals, the batteries, the motors, the actuators that are necessary for all of the capabilities that the department needs and the country needs, are financed using the power of federal credit. So the department did not have a federal credit program. It was one of 3 departments at the time of OSC's creation in the entire US government that did not have a federal credit authority. Whether it was used or not is a separate question, but we did not have one at the time. And that's a critical gap that authorities like the Defense Production Act or other funding mechanisms can't address. So we're here to meet the private sector, to meet private investors, to address that gap.
Thanks so much. And for folks who are just hungry to better understand these different federal credit authorities and the credit subsidies and all the complexities, we do have a lengthy call-out box in the report that unpacks that, because it's really important for private sector players to understand how you can pull down on the credit subsidies a bit differently for this highly risky sector compared to some of the other technology sectors that Asad mentioned. I want to turn to a broader question for all of you. As investment and financing arms of the US government, how do you guys coordinate with each other across the interagency on different funding opportunities or weighing different critical minerals policy considerations that are being put out through rulemaking and tariffs? Feel free to also reference other funding institutions that don't engage internationally, but some of our domestic focused funding institutions like the Department of Energy's Energy Dominance Finance Office, for example. Maybe I'll start with Sarah, because we heard from you last, and then move through the order here.
Perfect. Happy to jump in on this, and always good to see Tom and Asad, because not only do we tend to participate in these types of conversations, but we are either directly or through our teams engaging on a very regular basis when it comes to specific transactions. So not just themes that we're seeing in regards to new policies and such, which of course is very important, but also on our deal pipeline as well. And we've seen a great evolution in terms of that closeness of collaboration, specifically as it relates to critical minerals, because of the importance and the recognition that if we don't move faster and more efficiently together and leverage the different mandates that we have at our disposal as US government, we are not going to be able to solve the problem in a manner that is necessary, given what we've seen with some of the supply chain disruptions to date. In the past, what tended to happen was borrowers would shop around with the different US government agencies. And essentially what that means is, they would go meet us and meet DFC and DOW. And again, that continues to happen to a certain extent, but the level of shopping around has certainly been eliminated to a large extent because of the collaboration on the back end that we're having as US government agencies. And what does that look like in practice? Well, for example, we're a senior debt provider. We are statutorily limited in terms of our ability to provide equity. Some of the organizations can provide equity. Some of them are more focused on international deals, some of them on domestic deals. We all have our strengths. And so where we assess a transaction as EXIM, if it's not a clear fit for us for whatever reason, we would certainly be engaging with our peer agencies to try and find the capital. It's also a two-way street in terms of how that works. We have case studies where we have successfully engaged in different areas or different timelines of the capital stack for a specific deal. One that recently comes to mind is a domestic transaction that we've done called 6K Additives, which provides additive materials. It's a domestic project. DOW initially provided a slug of capital, and then EXIM came in with some larger CapEx financing down the line. And so that's a really great example of how some of our organizations can work together. Of course, we've got DFC and DOW on the line, but we heard from Reggie saying at State earlier, we work very closely with all four, as well as with Commerce, Treasury, DOE, and other agencies, depending on the nature of the transaction and the sector within the critical mineral as well. Our specific mandate is EXIM. Again, we're a senior debt provider, so that's where we come in the capital stack, but we've got a very clear mandate from Congress that we need to ensure we're creating jobs for the United States. So that's the lens through which we look upon for any transaction that we get involved with. And then also that we don't crowd out private sector capital, and that our funding actually brings in additional private sector capital. I'd say, and Abigail, perhaps you would agree with me on this, is that when you first started embarking on this journey of highlighting the importance of critical minerals, the financiers in the private sector were dedicated sector-specific, perhaps niche investors in the sector, given all of the activity and all of the importance placed by US government on critical minerals, which has now been elevated to the G7 and beyond. I would say that we're seeing new types of private capital coming into the transactions as well, which is, I'm very enthusiastic about in terms of us sort of achieving our a broader mission of bringing in more sources of private sector capital into these deals.
That's great. And yes, we are tracking that with incredible enthusiasm to see the growing capital allocation from, more institutions into this space. Also love your point, Sarah, on, instead of having the private sector project proponents shop around to you all to figure out the best financing, you have this in advanced coordination, leveraging your understanding of each other's opportunities and limits to be able to essentially more strategically plan and support projects, which we've been seeing in practicality in this space. Asad, maybe I'll turn to you next, and then Tom.
Yeah, thanks, Abigail. I think we're doing all the things that Sarah just talked about. We're trying to ensure that the taxpayer's dollar goes as far as it can, depending on the type of requirement. I think in AI, people these days call it token maxing. I think we're trying to do authorities maxing in some ways, where our authorities can go some places, DFC's authorities can go some places, DOE can go some places, and then we all sort of stack them together, and it works better. And I think just for sort of just to kind of add on to what Sarah said, the point around shopping, I think, is not so that we discourage folks from talking to multiple agencies or understanding how various parts of the government work. I think it's both, one, to be efficient for their purposes and to be efficient for the taxpayers' purposes, in understanding that all of us are looking at the same set of facts, the same picture for the same project, and multiple people aren't going after it. We collaborate very well with the DFC, with EXIM, with the Department of Commerce, Department of Energy, even US Department of Agriculture, and also internationally. The Department of War has collaborated on a number of things with the export, with EFA, and we're continuing to do so. So I think what we're finding is that the more we're able to leverage our collective knowledge, the better we can drive outcomes. And it's not just in transactions. We have leveraged experts from other agencies to sort of help opine on certain problem sets. And we have made our folks available to other agencies as well. The United States government collectively has technical experts in nearly every part of the periodic table and every part of any type of technical requirement. And the more we can leverage that collectively, that's also, I think, a win that we're trying to work on, more so than just pipeline sharing, which I think we've gotten really good at across our agencies and even across some of our international partners.
Great. Tom, not sure if you want to add anything to these kind of great context remarks on coordination, but I also wanted to make sure we asked you kind of a unique tool that the Development Finance Corporation has at its fingertips in providing political risk insurance, which the report found not many institutions have that. So feel free to add on in terms of the the interagency coordination, but also definitely want to hear from you on PRI and how you guys leverage that.
Great. Yeah, I think just to add, I agree with everything that Sarah and Asad said in terms of coordination. The couple points I'll add are, number one, in terms of informal discussions or venue shopping and that sort of thing, against all odds, over the past year plus, critical minerals have become like front page news in not only sort of the business, the business papers, but also in things like the New York Times. And so there's a lot of information out there that is, shared by people who have different incentives. And so I think the ability to have, conversations within different agencies in the US government, but also beyond, when I was at the conference on critical minerals and materials in Tokyo a couple months ago, or last month, I guess, we had a good sit down with the Japanese government and their financing agencies who were asking about things that they had read or things that companies had told them. And we were able to kind of, give a bit more detail to help them understand where they might fit in some of those investments. So that's one. The other part is, I'll note that increasingly as we have the US government financing different parts of the value chain and or different companies in the sector, I think there's going to be increased need for coordination on very specific granular parts of granular discussions around projects. And so I'll just give an example of our close coordination with DOE's EDF, formerly LPO, on the linkages between a project we're financing in Mozambique, the Balama graphite mine, and the active anode material facility in Louisiana that Department of Energy financed for the parent company of Balama. And there have been some challenges with each of those projects. And if you look at the underlying financing agreements, there are covenants and conditions and things that have impacts on what a covenant that might be in the loan agreement for Vidalia in Louisiana might have an impact on the financial position of the parent company, which then impacts on the covenants of the project in Mozambique. And so increasingly, I think we're going to have very detailed conversations like the ones we already have with the Department of Energy to ensure we're not tripping over each other or causing problems or having competing projects that are undercutting other investments. And so I think there's going to be a lot more granular discussions as well in the future. Just briefly in terms of political risk insurance, from the start, DFC and previously OPIC have been really focused on getting private sector investment overseas. And it's really not about the US government spending all of its money to make projects happen. It's about finding ways to use our targeted capital allocations or support to get more private investment going. And political risk insurance has, over the years, really demonstrated a strong ability to mobilize capital into riskier markets, emerging markets overseas. And so we really believe that there is a strong role for it in the critical mineral space. Number one, because there are a lot of projects that take place in riskier markets. These are projects that have large capital requirements and are long-lived, and they're immobile assets as well. And so you really have to find a way to protect against potential political risks. You combine that with the fact that investing in critical minerals is generally a bit more challenging and perceived as risky because of market volatility, lack of transparency in pricing. And so at the very least, our political risk insurance can really help to reduce the country risk that these investors might be exposed to, and potentially make it a bit more attractive for them to get involved. The reality is that the insurance is important, but the reason why we're able to offer it with a higher degree of confidence in riskier markets is because we back it up with US government political and diplomatic influence. So governments that are considering breaking agreements that they might have with investors or taking steps that lead to expropriation are likely to think again if they know that the US ambassador in that country or potentially even higher ranking officials are going to be calling them and raising concerns. And so that, I think, is a key part of this. I think that also just feeds more broadly into shifting role that the US government will have as we try to expand investment overseas in the critical mineral sector. I think Reggie's team at State is playing an important role, and this has become very front and center, but it's going to take, education and understanding and a willingness on the part of US officials to get engaged where there are challenges with these projects or, potential opportunities to try to help everybody be successful. So I think, the PRI is a specific tool, but it's sort of at the point of the spear of a broader set of diplomatic tools that help to ensure investments are safe overseas.
Thanks so much, Tom. And definitely the Vidalia Twig project that DFC has recently shifted their loan into equity is a really good example of interagency coordination. We've gotten a couple questions in the Q&A about how we need to kind of prepare for Chinese market dominance and the potential to influence prices. I know that's within kind of another corner of government being led by the Office of the U.S. Trade Representative, but just to say that transference of funding, helps prevent projects from being bought up by Chinese entities to increase their market dominance. And then also the integrated nature of that project helps insulate to a certain degree of some of those price volatilities. I'm going to turn to Asad and then Sarah for two quick final questions that I hope we can get to in rapid fire here. Asad, one thing that stands out for OSC, again, in the early deals is how quickly you've been able to move on timelines faster than what we've kind of seen historically from public finance institutions. This is a big finding of the report. Sarah talked about the urgency and efficiency needed. What's made that speed possible, and is it sustainable as your pipeline grows?
Yeah, we've put a lot of effort into some of our initial projects that you've seen be announced publicly. I think the singular mandate helps in many ways where we have a national security prioritization of effects and things that move the needle for national security, where we will move incredibly quickly. I think the base is also supported by sort of the way the OSC was constituted in the statute, where our kind of approval chain is maybe not as complex or long as some of our other interagency partners. So that's a statutory piece where our approval chain is sort of, I think, far more streamlined than what exists in other agencies, and that's imposed, of course, by the statute. I think as we grow, we up till a few weeks ago, we were sub 50 people with over 200 billion of lending authority from a credit perspective. I think there's a long way for us to kind of grow, and that's going to be really important because our pipeline has expanded to more than just critical minerals. We have 34 sectors that we have to look at by statute. Critical minerals is one of them. It's half of our capital by statute, but keeping the space up requires a significant headcount investment. Many of our initial transactions were sort of all hands on deck. We didn't have any other distractions. As we grow, that's going to get harder, but we're trying to staff up to meet that same kind of pace. Again, our goal is, from a national security perspective, to be as relevant as we can to the speed of transaction.
Thanks so much, Asad. Sarah, a kind of a closing question for you that's very relevant as XM is up for reauthorization later this year. And Asad talked a lot about kind of the importance of the statutes that have dictated OSC's ability to fund specific projects. obviously XM is in Congress's hands for reauthorization. So maybe a quick call to action to close us out in terms of where that's going.
Absolutely, and so topical as we're going into reauthorization in the tail end of this year. And for those on the call that may not be tracking this, internally, we often say that we're the only 92-year-old organization at risk of infant mortality, because every so often, every couple of years, we need to be reauthorized by Congress. Otherwise, we need to put pencils down and we cannot proceed with deploying additional capital. And there has been an instance in the past where XM has had a multi-year hiatus, and it really impacted not just our ability to support transactions, but our ability to ensure that U.S. exporters and U.S. companies remain competitive. And so this, is an imperative, very crucial year for us to ensure that reauthorization progresses seamlessly. Of course, DFC went through that last year, and so we've compared many notes with folks over at DFC about their process as well. Our number one priority, as I mentioned, is that we've got a robust long-term reauthorization. Certainty of our ability to remain in the market and deploy capital is of utmost importance. And so if all of our other asks don't make it into the mix, that is the one that we are very much focused on at this point. And we want to ensure that American companies have the tools to compete in an increasingly competitive world. We're talking about tenders and bids where it's not only the foreign financial institutions that are providing cheaper interest rates. It's sort of a subsidization of costs across the stack, whether it's demand drivers for the ultimate product or offtake, whether it's subsidization of land, of equity investments. All of that adds up. And so, we want to play our part in the play as XM to help American companies remain as competitive as possible. We're always evaluating what additional authorities could make the most sense, but we want to ensure that whatever gets introduced we remain faithful to our underlying mission and our responsibility to taxpayers. The one thing I would mention is there were some earlier points made around these transactions in the critical mineral space, particularly as it relates to niche critical minerals or junior miners or single asset companies. These are riskier transactions. I would just emphasize that as XM, we're a debt provider, and we have this conversation quite a lot with new borrowers, for example, that have primarily raised money in the equity markets. The way that you would engage an equity investor is very different from a way that you would engage a debt investor. Equity is looking for upside potential. As a debt provider, we're looking for repayment. And we're very thrilled. This year would be the first year that we are returning XM back to profitability in over a decade and returning those funds back to U.S. Treasury. And again, U.S. Treasury is the ones that fund us. And so we have a very deep sense of fiscal responsibility, given that we are funded by U.S. taxpayer funding at the end of the day. And so we need to balance that with our ability to lean into risk. That being said, we have been very creative with our existing mandate, and this is a whole nother conversation, so we won't get too much into it now, but using our existing statutory abilities, we were able to launch Project Vault. And the one sort of update that I would just leave for this group is that we did announce and appoint our executive chairman to Vault very recently, last week, in fact. Brett Lambert, he's got extensive experience in national security, industrial policy, and supply chains. And so we're thrilled to have him on board. But all to say that, if we can continue with even our existing mandates, we can continue to sort of be creative in the ways that we approach and tackle this challenge. And so the call to action, if you will, that I would leave to anyone that is following this matter closely is that we want to ensure that our reauthorization gets included as quickly as possible so there is no lapse in the process. And with that, I hand back over to you.
Thanks so much, Sarah. The report does do some analysis on the different G7 institutions' stockpiling initiatives, so you can check out our coverage of Project Vault there, and we're releasing more information on that. I want to thank you all for your time on this webinar, but also just for all the work you do. I know you're all working tirelessly to actually start to crack at our minerals concentration challenges. So really appreciate everything you're doing on behalf of the US and our companies and in support of our partnerships internationally. I'm now pleased to turn it over to Sylvia Gavrnikova, Head of Export Credits and Competitive Division at the OECD, to moderate our next panel. We are so pleased to have representatives from funding institutions across the globe to speak to how they're working on these issues as well. Sylvia, the floor is yours.
Thank you very much, Abigail, and welcome everyone. And I just want to mention that a SAFE report makes it very clear. No single institution, country, or financing tool can by itself mobilize the scale of investment required to build a secure and resilient critical mineral supply chain. One of the report's strongest findings is that the progress increasingly depends on coordinated action, co-financing transactions, aligning mandates, sharing risk, and combining public finance tools across allied countries to crowd in the private capital and advance strategically important projects. This panel turns into the international dimension, and I'm very much delighted to be joined by the 4 distinguished speakers who are at the center of this effort. Julia Beck, the Chief Strategy and Impact Officer at UK Export Finance, Dan Smart, the country lead for the United States and Canada at Export Finance Australia, Jan Klaassen, the first Vice President and Head of German Raw Material Fund at KfW, and Tushar Hendikar, Vice President for the Structure and Project Financing at Export Development Canada. Prior to turn to individual question to each speaker, let me begin with the short opening question for all our speakers. And this is connected with the international coordination, which is a central theme throughout the SAFE report. From your institution's perspective, where has the collaboration with other public finance institutions, whether through policy alignment, co-financing, information sharing, or other joint initiatives, been most effective? And where do you see the greatest opportunity to strengthen it going forward? I would ask you for a short intervention for all 4 speakers, starting with Julia, please.
Thank you so much, Sylvia, and thank you to colleagues at SAFE for this really excellent report. And I think the element of the report that I really wanted to kind of echo, which Sarah also mentioned on the previous panel, is that no single government or institution can really finance the full value chain of critical minerals projects that we want to be able to develop and deploy. And the capital requirement is just too large, the risks are too varied, and the value chain is too dispersed for a purely kind of national and a purely siloed approach. So I think for UKEF, which is the UK government's export credit agency, I think the imperative to be able to kind of develop our finance toolkit to be able to support these projects and support supply within the UK and within the G7 really ties in with our long-standing role, which is to help UK businesses succeed on the world stage and grow through trade partnerships. I think that started all the way back in the wake of the First World War. Through then, we've been supporting UK businesses through the oil shocks of the 1970s, the dot-com bubble, and the 2008 financial crisis. And I think for me, putting the current sort of strategic focus on critical minerals in that context of shocks and crises is really, really relevant, because I think what we are all seeing with some of the supply chain shocks in recent years is that this is becoming much more of a kind of a an economic emergency. So for us, we have been looking at expanding our ability to support critical minerals projects so that we can look not only at projects overseas that the UK is supplying into, but also projects that are coming into a UK supply chain that then translates into an export opportunity down the line. We're also able to support UK projects that are in the critical minerals value chain, and some of the examples there have been things like gigafactories, which serve the UK's automotive sector. And then we've also got a targeted product for early project services, and that's particularly relevant in the mining sector. Co-financing matters because critical minerals projects will have quite a diverse range of risks. They have very long tenors, they're highly capital intensive, and they require quite a big range of tools in order to make them bankable, which is what we as public finance institutions are here to do. So, for example, export credit agencies traditionally deploy a debt financing toolkit, which largely is in the form of guarantees with some lending. But also, I think in this sector, we need increasingly access to concessional and equity tools. So I think partnering across that sort of suite of public finance, including DFIs and export credit agencies, and also looking at how interconnected our critical minerals supply chains are, partnering with like-minded nations that where our supply chains kind of span across borders. So I think for us, that might mean, for example, that there's an opportunity to work for mature mining jurisdictions like Canada, where we've been working very closely with the Canadian Export Credit Agency, and obviously Tusha is on the call as well, in order to look at projects that might then have an onward supply chain into the UK. So huge opportunities, and really, really good to be in this group.
Great. Thank you very much. So you already mentioned Tushar, so I just turn to him to answer my first question, please, from the point of view of the EDC. Tushar, please, the floor is yours.
Yeah, thanks, Sylvia, and thanks for this invitation here. I think this, I mean, the topic is very, very important, kind of given the size and the needs of for financing of these large projects is no small feat, kind of for a single institution. So collaboration is the only way to go. There have been a number of examples of collaborations that have been brought together. But from an EDC perspective, I think collaboration is important, kind of given there are certain institutions that have certain that have strengths, and we need to combine all the strengths together, both in terms of how both the supply chain comes together, what the demand comes together, and all of that with the right level of support standing behind it, with the ability to take on risks, will help bring these projects kind of online faster as well. And I think that's kind of been demonstrated by a few examples. I'll just quote one for now. The Vulcan Lithium's kind of the Lionheart project last year, that some of my friends here on this that will be speaking shortly from KfW and EFA have also been part of these transactions, where we combine all our strengths to take on and parse through different levels of risks and see where we can each bring our capabilities together. And that's a great example of a pretty significant multi-billion euro project that was brought online.
Thank you very much. And you mentioned KfW. That brings me to Jan. If you can speak a little bit about the international cooperation from their point of view, please.
You're cut off, Sylvia? Yes. Thank you, Sylvia, and welcome everyone on the webinar. Thank you for having me over here, and I'm happy to address your questions regarding the cooperation from a KfW's point of view. And thank you, Tusha, for mentioning Vulcan. Yes, this was our first investment, which we made in cooperation with other investors. And there is one important point. We think cooperation is very, very necessary, as Julia and Tusha pointed out, given the volumes. But we would also need to see that us state investors always be in the combined number, be in the minority. We should not be the state funding issues to do 100% financing of a project. This should not work. We should cooperate amongst our state funding institutions, but we strongly believe in spurring private investors into a project with having the private investors the majority. I think the cooperation would need to be between state investors, state-related investors, and private investors to bring both knowledges together. Us with a longer maturity, maybe with a bit more patient, with a longer experience in the difficult mining sector and raw material sector, and the private investors with their push to see the market chances and to get to efficient project management. So this is one area of cooperation. Another one from my point of view is the standards. We should definitely avoid to be traded down against each other. The due diligence we perform on a project should more or less follow the same environmental standards, should follow the same risk assumptions, because if one of us is offering an investor an easy touch, you will not get back to the same levels of due diligence and projects you want to finance as a state-owned investor on a different project. So their coordination is necessary in order. We are always asked as a state investor to be on the forefront of technology, to be good on the standards and on the cooperation standards. So we should cooperate there, that there's no downtrading. The next one is licensing. Each of us may have an influence in the countries we're operating in, or if we combined, say, talk to national authorities that yes, this kind of licensing agreement is necessary, that gives a much stronger force than individual negotiating. And the last one is information sharing about good projects seen. And we shouldn't be focusing on a secret mission here. I think there are only a limited number of good projects available around the globe. And this is now the time when the good projects are either going to the Western world or going to our big red friends. And this is where we should do our information sharing and get a combined approach. So I think I'm within my time limit, Sylvia, and have answered.
Thank you very much, Jan, definitely. And thank you for sharing all four perspectives. I can only respond to one, that I'm very happy that OECD does not only offers the opportunity to discuss the financial terms and conditions, but also, as you mentioned, the environmental standards and the disciplines. Already started these discussions in 1990. So we are one of the oldest body, the export credit agencies, discussing this type of issues at the OECD. So that brings me to Dan, and if he could share the perspective of EFA in the area of cooperation and coordination and the strength going forward in this area, please, Dan.
And good morning to everyone, and it's a great opportunity to be on this panel discussion. From EFA side, I think it all starts with government cooperation and alignment. The governments are where the policy decisions and alignment is made. So from the funding agencies, we need that clear message from our governments. So that coordination and alignment, I think, is well in train, as is evident in the report, but continuing to do that will be key. That alignment and that messaging from government then flows down to us as ECAs and public financing agencies. And then our role is to assist in implementing that policy. So I think that is foremost in my mind. The next thing is direct relationships and engagement between the export credit agencies and financiers. Now, we maintain that we deal with all our counterpart ECAs. We have regular engagement. We share information to the extent we can within our non-disclosure obligations, secrecy and privacy obligations, but we make the other agencies aware of opportunities, allow them to actually be introduced. So our role is to identify where other ECAs and funders can be involved with the project as early as possible and steer that company to then engage with that ECA as early as possible so that the project doesn't go down a path that precludes another ECA joining at a later stage. The last thing from my side is continued understanding of every funder's mandates. That's really important. You know, I can't identify an opportunity and do an introduction if I don't understand. And this is where the SAFE's report has really been a good read. It's a great summary, and I would propose anyone within EFA that's joining looking at this sector, reads that report, gets a really good understanding of where the different players play. So thank you for preparing it. And that I'll finish there. Thanks, Sylvia.
Thank you very much, Dan. And we heard strong cooperation, strong information sharing area. So this is great that we are all like-minded. So Julia, let me turn back to you. We have recently seen that the UK government signals an expansion of the UK export finance mandate and toolkit. Could you please walk us through that review process, the changes being proposed, and how they will strengthen UK export finance ability to support critical minerals in supply chains? And perhaps more broadly, what lesson this might offer the other institution considering similar mandate review? Julia, please.
Thank you very much, Sylvia. So I think the starting point was really the UK government's modern industrial strategy, which was published around a year ago now. And that was the sort of the statement from the then fairly new Labour government setting out what our industrial strategy and our policy priorities were going to be for growing the UK economy and making sure that we are set up to support the sectors of the future. And I think what that strategy emphasized, and which is something that we're seeing increasingly in kind of industrial policy coming out of G7 peers and other partner governments around the world, is much more focus on economic security and resilience. So access to critical supply chains is just so much more of a policy imperative. Alongside that, we were also seeing new sectors. The UK economy is very sort of, it leans heavily towards services and technology, meaning that companies are now industrializing in different ways to the sort of traditional exports that we've seen previously. And so when that strategy was published, one of the things that we knew that we needed to do was to look at the statutory powers that UKEF has, and that's all our mandate is. It's the legislative powers that we have, to see whether supporting exports is all that we need to do. And I think one of the things that heavily influenced that was looking at not only the financing needs of our industries and their supply chains, was also looking at what our peer export credit agencies are doing. And so what we announced a couple of weeks ago is that in coming months, we're going to bring forward legislation that will expand our statutory powers so that we can finance supply chains. At the moment, we can do import financing, but only where there is an onward supplier to an exporting supply chain. So that will remove that requirement. And so that we can support outward direct investment beyond insurance, looking at kind of financing mechanisms. And alongside that, we'll need to look at our toolkit to make sure that our product and financing capability matches that new mandate. And I think it will also mean that we need to look at new partnerships with financial sector counterparties, and also with other ECAs and development finance institutions, to make sure that we're able to do that sort of crowding in piece, working with our public finance institution peers around the world.
Thank you very much. So let me move to Tushar and Dan. Since both Canada and Australia, as mature legacy mining jurisdictions, ECAs such as EDC and EFA play more traditional export promotion roles. But your governments have each stood up dedicated critical minerals tools in which your institution play a significant role, such as Critical Mineral Facility and Critical Mineral Strategic Reserve in Australia, and the Canada Critical Minerals Accelerator. Are these the best understood as a new institutions layered on top of your core mandate, or expansions of your roles in achieving the policy priorities? So I would ask Dan start first with the Critical Minerals Facility and Critical Mineral Strategic Reserve in Australia, please.
Thank you, Sylvia. To answer your question, I think it's a combination of both. It's both layered on our core mandate and an expansion. And why I say that is we still apply our traditional mandates. We always do that in our first instance. We look at providing commercial financing alongside commercial banks, most often other export credit agencies and DFIs, other government financing. So that's always our first port of call. A great example that Tushar mentioned is Vulcan Energy. That's on our commercial account. It was board approved on our side and we were able to implement it. The critical mineral facility and that was an expansion to our existing mandates. It really was put in place to fill gaps that our existing mandate couldn't fill. And there were a number of gaps that were identified. It also allowed us to provide equity investments. The Critical Mineral Strategic Reserve is the newer expansion. Now, that is a fundamental shift for us. It allows us to trade, to hold, and to stockpile physical and derivatives of the commodity. So that is the first time we're actually able to take a physical commodity and store it and trade and derivatives. So for us, it's important to just mention to the audience that both the Critical Mineral Facility and the Strategic Reserve are both us supporting, EFA supporting our government. Our government makes a decision on approving a particular opportunity, a deal, an investment, and that is under our national interest account, and then we implement that for government. So it's important that the audience realizes it's national interest account and approved at our government level. A good example of that is the Arafura Rare Earths project. In that deal, we used our commercial account, we used different parts of the national interest account, investments in subordinated debt, investments in equity, and there was an announcement on potential application of the reserve for an offtake. So you can see that deal is a great example of how all the parts of the mandate were applied. I'll leave it at that, Sylvia. Thank you.
Thank you very much. So Tushar, please, if you can share more about the Canada Critical Minerals Accelerator, that would be great.
Yeah, for sure. And Canada Critical Mineral Accelerator is just announced kind of earlier this month, kind of by the government. Very similar to what Dan kind of mentioned. I think it's also done in the recognition that there are certain layers of capital that might actually not be necessarily all available, kind of with the different forms of financings, kind of within both the Canadian ecosystem, EDC included, and other Canadian equivalent crown corporations as well, and therefore that accelerator has taken shape. The government has, we are working at EDC very in close collaboration with our friends at Natural Resources Canada in order to administer and manage that fund and its delivery. It's a $2 billion Canadian fund with a view to actually leverage that capital to bring and crowd in more funding support. So the key critical aspect, very similar to what Australia's philosophy is, EDC will be continuing to support, and we have been kind of over the past several kind of years on critical minerals. We'll continue to support those. This accelerator fund will actually help supplement some of it where it is necessary to supplement. But more importantly, I think it has its own objectives to build on and stockpile, kind of similar to what Dan said on equity, having equity investments where it makes it important for a Canadian kind of national interest supply chain, where Canada can actually bring many of its Canadian projects and potentially some international ones into the floor on an accelerated basis using this fund. We would want to continue to therefore work alongside at both EDCs and our corporate side of financing, but also with our ECA and DFI kind of partners and other private institutions to leverage that accelerator.
Thank you very much. So let me turn to Jan, as the report also traces a clear shift toward the equity across the institution profiles. My question to you would be that with the German Raw Material Fund and several other government-backed funds launched in the past 2 or 3 years, why the equity becomes such a priority instrument for critical minerals specifically, compared to the loans and guarantees that have traditionally been this institution bread and butter? And from KfW own experience, administering the raw materials fund and taking the equity in projects, what does government equity unlock that debt financing or grants cannot?
Thank you, Sylvia, for this three-layer question. I try to answer them within the time frame. First of all, we have still our bread and butter business on loans and guarantees and those kind of debt sector, and this will remain our bread and butter system. So just to recap, this is done for our commercial daughter KfW IPEX Bank. They offer, first of all, export-tied loans from Germany into the raw materials sector under ECA cover. Can be German cover, can be cooperation with other European sectors, as long as the equipment is bought in Europe and then used in a raw material business somewhere. The second one is the other way around. That's the untied financial loan. That's an import financing where a customer can use our funding to purchase the equipment anywhere he likes. That's why it's untied, as long as raw material and product gets into Germany. But both of it is on the debt side of the classical banking business, on the debt side. And KfW IPEX Bank is the originator and performer of that one. And this remains the bread and butter business. But the new kid on the block is the German Raw Material Fund. And this is opening a third pillar to equity-like financing instruments. This can be diversified financing instruments. It can be direct shares. It can be subordinate loans. It can be other forms of convertible bonds, convertible loans. There's quite a huge variety. Why that? Because equity, to us, seems to be the scarce resource necessary to bring a project off the ground. Debt is rather abundantly available through a number of institutions around the world and from capital markets. But where investors are rather shy is accepting long-term equity investments, which is necessary in the raw material sector. We're talking about decades, not about a couple of years. And this is why equity seems to be the scarce resources, and that's why we are offering in specific particular situations as a quid pro quo, you get a financing tool, equity portion from the German government in exchange for having an off-take contract into the German economy. That can be a European company producing in Germany. This can be a German company producing in Europe. But this kind of off-take is the quid pro quo for the equity investment. And your last question, what is different? Vulcan has been mentioned several times around this call, and Vulcan is also a good explanation, example for that one. There we have acted as an anchor investor to spur and to open up debt financing and other financing options. All of us in KfW, up to the Minister of Economics, received a number of calls asking, are you investing? Will you be there? When are you signing? When is your money coming in? As soon as you sign, then we sign as well. So this is the kind of role we see as bringing this new kid to the block, being in specific cases, equity to the case, to act as an anchor investor to give other investors the security that this is a real project, not something which is sitting there for 10 years. This is going to come to the market soon, worth investing, and you have an experienced investor along your side. So please, private money, come in and level up.
Thank you very much, Jan. You also answered one of the questions that was based from the audience in the chat. And the other one, since we only have 2 or 3 more minutes as we started later, is for all of you on the panel. If you see that the simple answer to all the questions from the respective government raising the risk appetite for the critical mineral project, if you think that the appetite of the government is raising from the perspective of your institution for this particular project. So I'll just start, Jan, since you are on the screen, you can maybe answer from your perspective, and then we go with Tushar and closing with Julia. Thank you very much. Jan, please.
Yes, I can definitely confirm that the raw material sector and the raw material business has made it up the political agenda. A couple of years ago, there was a lot of talking but no action. And even people were not knowing what kind of critical minerals are around. Now people can now define what are rare earths and can separate between the heavy and the light rare earths, and can separate what kind of equipment and raw materials you need for the defense sector or for the transformation sector. So yes, there has been a major change in the awareness of the governments, and there's also been a major change in the understanding that you need to have a sustainable delivery chain, not to be coming under political pressure from heavyweights around the world who would like to push you in a certain corner. And that there is the need to certain investments to secure an alternative and Western supply chain. But to also be honest and clear, after spending decades of exporting this, you cannot solve this within minutes.
Thank you very much. I have only one sentence from each. So Tushar, please, Dan and Julia, so you have all equal opportunities because we need to wrap up. We are over the time. Tushar, please, from the Canada perspective.
Yeah, and the answer is yes, and yes, and yes. That is the reason why there is this critical mineral accelerator from Canada that is now in place. We continue to, at EDC, continue to do a lot of critical mineral support. Last year was $8.5 billion of support, but alongside now the accelerator fund, we will get even more support out of the door.
Yes, Dan, please, very quickly.
Okay, thank you. Thank you. I think we need to just keep the momentum going. We've seen the momentum tick up. We've seen all these tools being put in place. We need to continue to implement it, to work together collaboratively. So it's continue with the momentum. Thank you, Sylvia.
Thank you. And Julia, just closing, please.
Thank you. So I would frame it less in terms of risk appetite and more in terms of ambition and what are you prepared to put on the line, which I know is sort of an indirect way of talking about risk appetite. But for example, the UK has stood up a £50 billion critical minerals grant fund, which is quite a different proposition to some of the more sort of traditional tools that we might have seen previously. So I think it's much more about sort of ambition, innovation in the policy space and in the financing space to be able to do more.
Thank you very much. And let me go back to Abigail. Thank you all four speakers. Thank you very much for your intervention. All the best.
Thank you so much, Sylvia, Jan, Dan, Julia, and Tushar, for your time on the webinar and also your and your team's time to review the report. We really appreciate it. The examples mentioned on Vulcan, the one-stop shop within XM and EFA, Canada's new critical minerals accelerator, and UKEF's mandate shifts are all covered at length in the report, so just more invitations for you guys to read. I'm now pleased to introduce Youssef Khan from the Wall Street Journal for our last panel, where we will hear from the important private sector leaders who are collaborating with governments on these issues. Youssef, I'll trust you'll be punchy with your questions, given we have limited time left. Over to you.
Thanks, Abigail. I appreciate it. Here we're this last session is going to focus on the private sector perspectives. I'd like to introduce our panelists. We've got Frank Fannin, co-founder and managing partner of Orion Critical Minerals Consortium, Helena Matza, Chief Strategy Officer at TechMet, and Sylvain Eckert, partner of Critical Minerals at Infovia. Thanks all for being here. So this first question to you guys is it's going to be to all of you. So your organizations each represent a different model of public-private engagement in critical minerals. Infovia Critical Metals Fund is privately managed with French government seed capital. TechMet is an operating investment company where DFC has taken a direct equity stake alongside private capital, and Orion CMC is building a consortium model that brings in allied governments to support critical minerals development. Given those distinct structures, why is public-private partnership effective in the sector? And what does each side bring to the table? What specifically is useful for financing these critical minerals? I think we'll start with Frank if we can.
Yeah, great. Thank you for having me. Great to see you all. Yeah, I think I'd start kind of going back a little bit with Orion Critical Minerals Consortium and who Orion Resource Partner is, because I think that lays a foundation for a broader investment thesis. Orion is one of the world's leading private capital providers focused on mining and metals, which is a pretty unique group of private capital. Orion's been around for 14 years roughly in its current iteration, and it has built about 100 mines, which probably makes it one of the largest mine finance groups, most experienced in the world. And they do that through a unique kind of set of offerings, investing across the capital stack. Equity, debt, production-linked instruments, et cetera. And they do it based on a team of technical expertise that this is all they do. They focus on the aspects. The government component is an investment not into Orion Resource Partners, but we created a separate company with a particular mission set to secure critical materials for allies and partners. And so it's a distinct company managed by, but it has the experience of the Orion Resource Partners brings. And it's working with governments, both the DFC, we're very proud of that relationship, as well as the Emirati Sovereign Wealth Fund, have invested, as well as Orion's invested their own capital, equal measures of $600 million. So Orion, the private sector, has skin in the game. I would say that what this structure brings is polarized some degree of a political de-risking for sure, depending on the country. The kind of that soft diplomacy model that the U.S. capital, Uncle Sam's investment brings, as well as the Emiratis, depending on the country. That's pretty powerful. But really, it's benefiting from the experience, investment experience, and technical chops that Orion brings, and the committed capital of Orion sitting alongside. So first and foremost, to make this an enduring collaboration consortium is not to lose money. We're all in this to get a return, but the mission set is to secure materials, make a favorable return, and manage the logistics of the material. So it is a unique offering, and it starts with first principles about returns and alignment on that key mission.
Thank you, Frank. Helena, what are your thoughts on this?
Yeah, thank you so much for having me as well. So, our model is similar but slightly different to the one that Frank just laid out. So maybe I'll just take a moment to explain that and give you some context of the nature of our relationship with the U.S. government and sovereign lenders in general to date. So TechMet is a critical mineral investment platform. We have 10 portfolio companies around the world. And TechMet as a whole, as a common platform, has received investments from the Development Finance Corporation, 3 of them actually, over the course of the last several years, starting in 2020, when the DFC was originally reconstructed after OPIC, and then was one of their first equity investments ever. Our model is slightly different than some of the other critical mineral investment firms in the sense of we're not raising individual funds with specific mandates. The whole firm is designed as a permanent capital vehicle. All participants and shareholders, like the US government, have common shares in the company and exposure and opportunity across our whole platform. And that's unique for a couple of reasons. One, similar to what Frank outlined with the mission of the CMC, ours is quite similar. Our job is to support the development and reorientation of Western supply chains. So our ability to invest in a project and stick with it, not on a particular fund schedule, but on the amount of time that really takes to develop that project. And I should say we generally provide late stage development capital. So we're not doing a ton of feasibility studies for greenfield projects. We're coming in and getting a project ready in those last several years to operationalize and bring new tonnage ultimately to the market and to the West. So I think an important tool and vehicle that really does align with that national security imperative. And so with having the US government in our capital stack as an important shareholder, we also have the Qatari Investment Authority as another sovereign lender, and then several different relationships at the asset level with the US government, with the UK government, with the Swedish government. But Frank is exactly right. That is only an element to the overall formula. The job is to both build these assets, ensure that we are orienting these supply chains to the West, and bring returns and value to all our shareholders. And so I think TechMet provides a really interesting track record and example having now investment from the US government directly into the organization for over 6 years, we've been providing, 30% returns year after year. So a good demonstration now with many others joining us in that story of being able to be a company that really does tackle national security imperative, but also can make money and returns along the way.
Sylvain, did you have any thoughts on this as well?
Thank
To get yours.
Thank you very much. Thanks for having me on that webinar, and thanks also to SAFE for the very fulsome work on the report. And clearly it highlights the need for coordination and cooperation amongst public capital sources, but also between public and private capital. I'll be speaking from a EU investor perspective. Our primary goal with the investment that the French government made in Fravia was to mobilize private capital from European investors, not only French, but also German, Danish, Italian, and other countries, as well as potentially EU bodies, and demonstrate and steer that capital toward the sector, which has been essentially abandoned by the EU investor for quite some time. There were key issues that we had to address to attract European capital into that sector, like perception and reputation risk, the technical risk, all of which are being highlighted in the SAFE report, and also the price volatility. So from that perspective, the seed from the French government was an essential component on making sure that the sector benefited from a more positive perception than historically, and it was essential that the French government was an investor in that strategy, but pari passu with all the other investors, no special governance right, and driven as Orion and TechMet by delivering a return to our investor. So why the assemblage of private and public capital is effective? It's essentially because private capital brings commercial discipline, fast execution, the ability to source deal more effectively, to understand the technical and metallurgical due diligence, and negotiate at the speed that typically public institutions can't, because they don't have enough in-house expertise. The capability to structure complex investment, like Frank described, and but also Jan, convertibles, offtake, streaming deals that match project cash flow profiles and permit to return the capital with a performance to the investor. What public capital brings in our case is the credibility and the signaling effect. A sovereign checks materially lower the perceived risk of the private capital, the institutional investors, and which is why our vehicle, shows that private capital arrives after the public money, but is being steered by the public money. One of the key things that the public capital brings is the policy and diplomatic alignment. Typically, we benefit from the French diplomatic network to have access in countries where we do want to invest. And lastly, we benefit from a very large investment from the French government, which is not sufficient to de-risk all the value chain for the European industry as a whole, but is substantial in terms of steering and signaling the need towards the private capital sector. Thank you.
Thanks, Sylvain. And actually, I'm going to stick with you for the next question. So one of the things that we were all very excited to see that InfraVia's Critical Metals Fund completed its first 3 investments. Looking back at your journey from seed capital to first deployment, what's the biggest lesson that you'd pass on to newer, similarly structured funds like Canada's CCMA or Italy's NMIF, which are still being operationalized?
Yeah.
Just to add on to that is, like, with these deals under your belt, what does InfraVia's pipeline look from here?
Sure, thank you. I mean, again, speaking from a European perspective, the key lesson for us is not to underestimate the level of education that is required to attract institutional investors. That has taken us a substantial amount of time and effort, and we do recognize that the situation is quite different between Europe and other mining jurisdictions, as Australia, Canada, and the US, where you have already some some funds operating and where capital markets are well developed. Sorry. I note though that it's easier to raise money for a gold project at the moment than it is for critical minerals. So overall, the first recommendation is do not underestimate the need for education for private investors, and that education is actually well facilitated by the various initiatives such as SAFE and recommending notably a better transparency of the sector. The second lessons learned is the need to build flexibility to make sure that we can effectively develop the steps of the value chain that are independent from each other, or as that has been described in the SAFE report, to address the circular dependency problem. It's important to think that the critical metals are not silos, but to think in terms of ecosystem, and probably ecosystems that goes much broader than just the critical metals or the extraction sector, but to think also the chemical sectors when you're talking about batteries, and as had been evidenced by the Hormuz crisis. It's important to think in terms of the assets themselves that will produce critical metals, but also the assets that will produce the chemical reagents that will produce the reagents that are necessary to produce those critical metals. So you have to think several levels beyond those value chain. A good example, sulfuric acid for the production of copper, for example, or for the production of nickel cobalt sulfate in Europe. And thirdly, the ESG standard. Don't try to reinvent the wheel. Use what's existing already. The existing investors, such as ourselves and the rest, and the new investors should use what already exists and converge towards a common set of requirements, and not try to have competing sets, which is a kind of counterproductive. In terms of pipeline, frankly, there are plenty of opportunities out there. There's no risk, maybe for one or two, but there's no risk of shortage of critical mineral projects. Not all opportunities are created equal, though. It's a filtering exercise as much as an identification of new opportunities. At the moment, our pipeline is quite strong across multiple critical metals, copper, lithium, and tungsten notably, but really across the full list of the European Union, the 34 CRM list. And after 3 transactions at the beginning of this year, we are quite hopeful that we're on a good trend and that we are going to land further transaction in the second half in the metals that I've mentioned.
Thanks, Sylvain. Really appreciate that. So coming back to all three of you, with so many public finance tools available, I think we heard it earlier referred to as agency maxing. DFIs, ECAs, government-backed funds, stockpiling, offtakes, etc. How do you decide which institutions or partnership models is the right fit for a given project? Does layering multiple public sources into one deal speed things up, or is that just, amplify the due diligence burden? I'm happy for either anyone to come in on this. Elena, why don't you go first?
Sure. And I like the term agency maxing. It makes me feel like it's part of my fitness regimen. So I'll keep that in mind. Look, definitely for someone who's new to the space, I imagine a complicated ecosystem to navigate. But when we really take a step back, the reality is each one of these public financing tools do offer something unique and generally are trying to address a different part of the supply chain or a different phase in a project development. And so I think from an investor perspective, as we're thinking through what is the right partnership model for one of our assets or our company as a whole, we really do need and are most successful when we zero in on the issue that we're trying to solve and then identify the right tool from there. And the one thing that is happening in the US government system that's been quite helpful is just a deepening understanding publicly of what's available and what each agency's mission really is. And so I unfortunately wasn't able to join earlier, but I saw many colleagues from the US government speaking. So I'm sure there was references to, OSC's ability to, lend $200 billion of authority for onshore manufacturing, the Department of Energy, in addition to its loan program, is putting forward $1 billion across new initiatives for domestic production and recovery and commercialization of late-stage critical mineral projects. We know and are developing a deeper understanding of, Project Vault and how their loan and partnership model will work on their efforts for the civilian stockpile. And then, of course, there's the role of both the multilateral agreements that are coming out of G7 plus, but the reality and a little bit of what I heard at the end of the last session about where and how different MDBs and DFIs can work together. So I do think the way the ecosystem's still set up, it's incumbent on us to really try to match ourselves both with the right tool set and the right partner from the front end. And, that doesn't go without complication, like you do with any investment or fundraise. You are running multiple due diligence processes at the same time. And I think, one of the report recommendations was around the idea of, how on the government side, can you consolidate that both to save the taxpayer money, but also for efficiency perspective. And, that would be a major move. But the reality is when any of us are going through any other version of different entities coming into a project or our assets directly, this is very typical to run a handful of processes at the same time to make sure that every investor understands what the value proposition is. And so it really comes down to that, the right matchmaking on our side, and then an understanding of what our portfolio and projects need at a certain time. Depending on where my project is, if I was doing something more nascent, which isn't usually TechMet's area of focus, you start with TDA and you start with project feasibility and try to get that US flag into your project early. Or if you're thinking about, the right equity debt mix and the right type of exposure, I would have different conversations with DFC, XM, and other entities. And so I think one thing that G7 countries are doing really well, and the US in particular, is making it a lot more clear what they're willing to do and not do. And then it's really incumbent on us to find the right way to work within the system.
Frank, did you want to come in?
Yeah, sure. I mean, I would say that to expand on that, I mean, the other point is different agencies are looking at, funding agencies are looking at investments based on where they sit. So that's going to create some parameters on what they find investable based on their own mandate. The Energy Dominance Office at DOE will invest in certain things, whereas the Department of War will prefer to invest in other things. The DFC is an investor in ours. They're looking at things more just basically outside of the United States now, and they've gone through an evolution itself. Firstly, very much targeted emerging markets and the historic sense of emerging markets, and then through the reauthorization, they've had increased flexibilities on where they could potentially invest. So each of the investment kind of partners from the U.S. government side are looking at looking at the world from where they sit, which is natural. So can you create these models of Venn diagrams where you see the overlapping equities and then you kind of target that? The other ECAs, I think, wonderful that they're going to start deploying some capital. They've been talking about lots of things, and Brussels have issued lots of reports for a long time. So it's great to see the mobilization of actual dollars. The talking about the problem isn't going to change anything. So it's really about movement, action, deployment of capital, and building stuff. And that's what we're here to do. And then for us, also the screening that we're focused on, we're only focused on projects that, Orion has multiple projects, products. They have a hedge fund, they have a venture side, they have lots of things, but the Critical Minerals Consortium is focused on projects that could be optimized, that are in production right now, could be expanded, can be optimized, or can be put into production within 3 years or less. So it's a bit of a screening tool that we have, and some of the funding agencies also, back to that interplay of Venn diagrams and where you see the overlapping interests, and that's kind of how we would target that. But it could be dizzying for someone who's not in this game and hasn't been in it for a while. If they're just kind of coming, where do especially a foreign company who's coming to Washington and sees not just America, perceives America having a checkbook, but multiple checkbooks open. But there is a method here, and I think they also recognize the White House has been doing a pretty admirable job at trying to coordinate interagency funding and prioritization of projects based on, again, where they sit in terms of a broader mandate than perhaps one particular federal agency might view the world.
I know as a reporter, trying to follow that is quite tricky. So I can't imagine it is for companies. Sylvain, did you want to give anything from the European perspective?
Yeah, very briefly, I'm quite aligned with what Frank and Elena said, but yeah, it's really much a tool in a toolbox approach and find the right tool in the toolbox that is matching the set with a requirement of a specific project. On our side, we are just mapping constantly the mandate of the various institutions, so public institution, ECAs, DFIs, etc., but also the private actors as well, the traders, the commercial banks, the credit funds, in line with what the SAFE report does actually. And when we approach a transaction, we simply look at the mapping and who is going to be best suited to accompany us in the structure that we have in mind, and obviously to maintain that mapping, we are in constant dialogue with the institutions that are relevant to our scope of investment.
Thanks. Helena, TechMet's relationship with TFC took shape under one administration's critical minerals push, but the assets you're developing will go beyond, multiple election cycles. Policy durability across administrations remains an open question. There does seem bipartisan political support, though, in general. From the private sector's perspective, what signals would most reassure you that public finance support for the sector is durable, rather than tied to, a single particular political moment?
Yeah, Yusuf, thank you for that question. And TechMet takes great pride in the durability of our relationships and capabilities along our whole portfolio. And you're totally right. We did receive our first investment from the U.S. government in 2020 during the first Trump administration, had subsequent additional investments from the U.S. government during the previous administration, and us and all our assets working very closely with the current administration. And I should say that's not just our relationship with the U.S. government, as I said earlier, strong relationships with the Qataris, the UK government, the Norwegian and Swedish government as well, and probably many more forged over time. And it's an important part of our DNA and an important part of how we structured and developed our organization. So one of the things that I think are really important, and critical minerals do find themselves in a unique infrastructure class for investors, because in addition of all the complications that come with any large scale infrastructure project, i.e. the amount of capital it takes to develop that project and the amount of time it takes to develop that, we do have a real national security challenge in the sense of not just security of supply, but in responding to, non-market actors really affecting the whole kind of ecosystem of investment. And so government's view and prioritization of critical minerals as a national security imperative is an important piece of what investors think about, of like how long and durable they are, both political support, which has a lot to offer. It's not just the financing, but then of course these financing products. And so a couple things that we watch that gives us confidence that this energy will continue to materialize, as Frank referenced, into more dollars mobilized, because that's a huge piece of this. One, it's been very helpful to watch the G7 plus coordination and commitments start morphing into more practical tools and coordination around trade and market platforms. We needed a couple years of just governments identifying critical mineral and supply chains as a national security imperative. But we're past that moment, and like these platforms, dollars, and coordination is a really important signal. And the fact that they keep evolving and improving is a good trajectory. In the case of the US, I think the formula I'm going to say is simple, but when you hear my list, not probably so simple. But look, the continued bipartisan support we're seeing on the Hill is Democrats and Republicans are both sponsoring legislation that help codify funding capabilities, but also authorization of different agencies' capabilities in supporting critical mineral projects and supply chain security is an important thing to watch, and we watch very closely. Most importantly, congressional support and mandated financing tools being deployed in out-year budgets is something we'll watch in every budget cycle. And I think investors that are thinking about the role of government will and do pay attention to. So DFC reauthorization, some of the elements to their equity fixes that were sorted out, some that weren't, but we all pay attention to that. We want to understand that our partners are able to continue to invest in this space, and that is still kind of the general political tide, which is something we've definitely been watching. And then I think kind of the last leg of the stool in the US context is we watch what legislation is passed and how tax incentives and credits are developed, and do they survive a full tenor of their initial, legislated authorization. All of those pieces, not one of them by themselves makes or breaks an investor's view on policy durability, but together that trending in a positive direction is a huge piece of our calculus about how fast we can expand, how far can we stretch ourselves. And all so far feels like it's trending in the right direction.
Thanks, Helena. I've got one more last question for Frank before I hand back to Abigail. Orion CMC has taken a different approach by bringing allied governments together through a consortium model. SAFE's report highlights that governments are increasingly prioritizing critical minerals and allocating more public financing, but those efforts are quite fragmented. How does Orion CMC hope to translate the growing political momentum into coordinate project development? And how do you see that consortium model adding value beyond what public finance can do?
Yeah, I think beyond public finance can do, because yes, the public institutions, the DFC and the Emirati Sovereign Wealth Fund are invested. They're partners. They're partners equal to Orion's own investment. So I think where the public institutions might look at things in a direct kind of project approach, we're looking at a whole pipeline and creating a portfolio approach, and we're doing it at scale that's not been done. And so we're taking, really looking to get kind of needle mover kind of opportunities. We're developing some of those. Some of those we're having the benefit of having a political overlay, government to government, as in the case of our investment to acquire 40% of Glencore's projects in the DRC. It's under the auspices of a US DRC strategic partnership agreement. So it creates a little bit of a political tailwind as well to create that. But the other point I would underscore is one of the, particularly in the emerging market world, many countries really want to see US investment in their countries, for US companies investing. And there are very few of them. They want to say that they're open for investment to attract more US dollars into their country. I think for the US investment, Emirati sovereign investment can help de-risk or address perceptions, but Orion's private owned dollars investing in a country is the best signal, the best validation of a counterparty government to say they are actually open for business, rather than just a public financing institution. The World Bank money or that's good, but it doesn't send the signal to attract more private sector activity into country. And so I think that's one of the other components that's really a differentiator in terms of the approach that we're taking. And lastly, we're focused on those near-term producing projects, and that's getting the material and trying to change supply chains in a pretty material way, using Orion's logistics to help do that and move material around the world. Thank you very much for the question.
Great. Well, thank you, Frank. Thank you, Helena, and thank you, Sylvain. I'm going to pass back to Abigail now to close this session out. But I appreciate it. Thanks, guys.
Thank you so much, Yusuf, Sylvain. Helena and Frank, for that really insightful panel. I want to thank a final time all of the panelists and moderators for joining us today and for their continued engagement on this research and publication. As you've heard many times, solving the critical minerals funding gaps, especially in a non-market environment, takes a village. And many of the folks leading that effort were able to join us today. As Dan Smart put it, I hope Critical Moves offers a practical roadmap for public finance institutions, project developers, private investors, and that all of today's conversation marks a step forward, turning all of the policy commitment we're tracking into finance projects. We look forward to continuing this work, and please reach out if you have any questions on this research or if there's more for us to do. A final thanks to Ayelet, our communications team, our development team, our government relations team at SAFE, all of whom had great input to make this possible. Thanks. Have a great rest of your days.